Hey y'all, Lisa Davis, a trusted banker, and I want to give up some hot topics today. Let's just talk about some stuff. I'm on YouTube. Hey TikTok, I'm on YouTube doing my update on YouTube. So today, let's talk about first things first. I did want to talk about this that came out because I feel like I'm going to be sending it a lot of different places. So Community Bank and Trust announced that they're going to do refund anticipation loans for the sick leave and family leave tax credit, also known as the self-employed tax credit, the SETC. So this is targeted at small business owners and self-employed individuals like gig workers, sole proprietors, contractors, people that access their funds through 1099s. Business owners are advised to inquire about the additional costs for accelerated funding. I know we all want our cash and our money now, but there are costs around that, and I am always the one to tell you to watch the monies that are being charged for these processes that seem to give you advanced funds or anything like that and make life easier. Sometimes it comes at a cost, so just make sure that you know how much this service is going to cost you. Okay? The next thing I want to talk about is I'm doing my YouTube updates, TikTok. Hey. So the next thing I want to talk about is the Community Bankers Association. So let's get to that. That article, where is it? Community Bankers right here. So the Community Bankers Association is urging Trump to eliminate Rule 1071 and 1033. So why is this important? These are regulations that came about in the Dodd-Frank Act that came about from the mortgage meltdown. So when you think about what happened with the mortgage meltdown and how consumers were unprotected with the interest rates that are being charged and the subprime lending and the foreclosure and everything that happened during the mortgage meltdown, understand the Dodd-Frank Act had protections in place for consumers. So the Independent Community Bankers Association wants to get rid of Rule 1033, which is through the Consumer Financial Protection Bureau, the CFPB, and it requires financial institutions to share customers' data with the customer and authorized third parties. And this rule is intended to give consumers more control over their financial data and to promote competition in the financial services industry. What does it cover? A wide range of financial products and services, including bank accounts, credit cards, mobile wallets, and payment applications. The goal of Rule 1033 was to prevent misuse of consumers' financial data and to encourage consumers to switch to better service providers if they're not getting the service that they need, and also to discourage risky data collection processes. You know, we're going into the digital age. We got these digital brokers out here buying data left and right. And so this rule really does protect consumers. And who does the rule apply to? Certain banks and other data providers, including digital wallet providers. They also are asking the administration to get rid of Section 10, Rule 1071, which is another rule through the Dodd-Frank Act, which requires financial institutions to collect and report data on lending to small businesses, women-owned businesses, and minority-owned businesses. This rule aims to promote fair lending practices and accountability. And let me just tell you, the Dodd-Frank Act came out 2010, 2011. When I say banks have been fighting this rule ever since it came out, which is why it hasn't been implemented, and every time it comes time to implement it, banks find another reason not to do it. But this rule will help with fair lending to small businesses to ensure that everybody that applies for a small business loan has equal and fair opportunity to get a small business loan. So it's similar to the data that's collected for mortgage loans. And you guys know how we've seen from the mortgage data, or if you don't, because mortgage data has now been collected, we're able to see what areas banks are lending in and who they're lending to, and especially in large urban areas where there's a large population of Black and brown people, if the banks are actually lending to a corresponding percentage of Black and brown people as reside in those areas. So these rules are actually keeping banks accountable, but that's where we are. Banks don't want to do it. So the ICBA administrator asked to revise the CFPB's rulemakings for these regulations and to recommend that they reconstitute the FDIC and the CFPB's community banking advisory committees. So what does that mean? That means that Trump did get rid of the advisory committees. Stop screen. Let me pull that up for you. A couple of days ago. He signed an executive order to reduce federal bureaucracy, eliminate community bank and credit union advisory committees. So at least the Community Banking Association is asking for those to be restored, because on February 19th, President Trump issued an executive order to significantly reduce federal bureaucracy size following the administration's policies to minimize government waste, which these did not minimize government waste because they weren't being paid for by tax dollars. And he asked that they get rid of the advisory committee for the banks. Where's the one? The Community Bank Advisory Council and the Credit Union Advisory Council. So at least the Community Bank Association is now asking that President Trump puts those back over for their advisory councils, because banks need that. They need the information. They need the information that these advisory councils collect and aggregate, the data they aggregate, and the oversight that they provide. Next is the FDIC stops reporting total assets on banks on the problem bank list. This is very concerning. So let's pull that one up. FDIC. So acting chairman of the FDIC Board of Directors, Travis Hill, who was sworn in, as FDIC chairman on January 5th, along with, released a statement yesterday, February 26th, that said the materials in the quarterly report by the FDIC on FDIC insured banks that the FDIC would no longer disclose as of today total assets on its problem bank list. The list has previously shown total assets and the number of banks on the problem bank list. As of today, it only shows total number of banks on the problem bank list without the assets. And the sudden end of this disclosure is a problem because as you can see from this graph, you can see how it went up right when we were having the subprime meltdown from 2007 and 8. It went up and then it went back down when we got it back under control. We had over 800 banks go out, right? Back in the day when we had the subprime mortgage meltdown. To not disclose the problem asset, the banks with the problem assets, is a little bit of a worry, because it can say that full transparency, right? The reason concerned that full transparency could lead to a disorderly bank run. This marks a significant shift in regulatory practices, indicating regulators prefer managing public perception over full transparency. The decision means we'll no longer have insight into the scale of potential risk in troubled banks, and this mirrors past actions seen during 2008 financial crisis, as well as the recent bank failures like Silicon Valley Bank and Signature Bank. If the public had full transparency, it could trigger instability, and this implies the system may already be fragile. So the fact that they want to hide it from the public just shows that, yeah, the banking system might be fragile right now with all of the things going on with this administration. Public confidence is down. So yeah, it's not seeming to be very strong, but it's important that the public knows exactly what's going on and what banks may be a trigger for failure, just so the consumer can know, especially if they're banking there, because it does poke like at consumers that have a ton of money in those banks. How are their money going to be covered? Are they going to be insured? Where their deposits going to go? So it's just not a good idea to hide this information from the public. The next one is, why are companies holding large cash reserves? So somebody sent this to me yesterday. Let me move this out. And I had to take a deep dive into it yesterday because it was interesting, right? Especially because Berkshire Hathaway was there. So these are the U.S. companies, and this is all public record, public knowledge. This is on TradingView. U.S. companies with the most cash on hand. So these are the companies with the most cash on hand, and at the top is Berkshire Hathaway. Now, Berkshire Hathaway is known, Warren Buffett, for investments and all the things, invested in the stock market and everything. But now he's cashed his business, has $334 billion cash on hand. So I did a deep dive into this to see, well, why do these companies, especially the ones that are listed on this report, they're the top companies that basically were at the inauguration as well, right? We got Amazon, we got Google, we got Charles Schwab, we got Meta. Like the top 5 are holding a lot of cash. So what does that possibly mean for America, right? Why are companies like Berkshire Hathaway cash heavy, holding large reserves on their balance sheets? So cash heavy refers to corporations keeping large amounts of cash instead of investing or reinvesting it. And the possible reason for this is economic uncertainty. So companies may hold cash as a safety net during uncertain times. And if you guys have been following me through everything that's been going on in this administration, I keep telling you, cash is king. You can also invest in some metals like gold, platinum, and silver. But cash is going to be king right now. Tax considerations, they're thinking about avoiding high taxes on repatriated profits, especially from multinational companies. But for American companies, lack of investment opportunities. If profitable opportunities aren't visible, companies might hold on to cash instead of risking it. And with the thing, I feel like with the instability of the market, there's going to be a lot of opportunities coming in the future for good investment, because we're going to see some big businesses go down. We just saw one of the contracts with the Department of Defense, the contract that one of the companies had, where the stock was just elevating extremely well last week, just took a big fall based on remarks made by the administration. And so we're going to be seeing a lot of stocks being very volatile. There's going to be a lot of opportunity for investment. So these businesses having cash on hand and being very liquid is going to probably be a good strategy for them to invest when the time comes. And then the last thing I want to talk about is consumer confidence. Consumer confidence. Well, that's not the last thing. I have one more. Let me see what this one is. But consumer confidence is down. It takes a dive under the administration. U.S. consumer confidence dives. It's the biggest drop in 3.5 years. Reasons being maybe tariffs on imports, mass firings of federal workers are some of the issues taking a toll on consumer psyche. The United States consumer confidence deteriorated at its sharpest pace in 3.5 years in February, while 12-month inflation expectations surged, offering further signs that Americans are growing anxious about the potential negative impact on the economy of President Trump's policies. So this is something that's going to be followed, because when consumer confidence is down, it just domino affects a lot of different things. Economists said unprecedented layoffs of federal government workers were also taking a toll on consumer psyche, which they said posed a risk to spending, the main engine of the economy. So we're going to keep watching over all of these topics. There's one more thing I did want to talk about. Let me pull it up. So today it says Trump takes control of independent agencies, and this was written yesterday. The independent agencies are the CFPB, FCC, FDIC, federal agencies, Federal Reserve Board, FTC, and the National Credit Union Agency Association, saying that independent agencies have exercised enormous power over American people without presidential oversight. President Trump has issued an executive order, this came out yesterday, placing those agencies under his control. And while Trump specifically mentioned the FTC, FCC, and SEC, the definition of agency used in this order also includes financial regulators as of the FDIC, OCC, CFPB, and the NCUA. So the FDIC, Federal Deposit Insurance Corporation, OC is the Office of Comptroller of Currency, CFPB is the Consumer Financial Protection Bureau, and the NCUA is a National Credit Union Association. Specifically, Trump said that independent agencies must submit draft regulations to the White House review, with no carve-out for independent agencies, with exception of monetary policy functions of the Federal Reserve, and consult with the White House on their priorities and strategic plans. The White House will set agencies' performance standards, and the White House also will adjust so-called independent agencies' apportionment to ensure tax dollars are well spent. Until now, each independent agency has issued its own rules And most financial regulators have been funded by fees paid to those entities they regulate, making it unclear how such funds might be apportioned in the future. Apportioned. Listen, when the White House gives the excuse of we are cutting costs and we're trying to make sure that the Americans' tax dollars are being saved, are being spent correctly, and we're trying to cut costs, what we need to understand is these independent agencies that were created through Congress decades ago are not funded by tax dollars. There's such a big misconception that these entities are funded by our tax dollars, and they're not. And so when they keep stating the things that are not true and confusing consumers and just Americans about how tax dollars are being spent, it creates a lot of backlash, and it creates a lot of confusion with everybody. These entities are not funded by tax dollars. They're just not. Trump's salary is funded by tax dollars, but this is not funded by tax dollars. So the order drew immediate criticism. The co-president from Public Citizen blasted the administration for issuing the executive order, saying this is a profoundly dangerous idea for the nation's health, safety, environment, and economy, and for our democracy. Congress made independent agencies independent of the White House for good reason. He said that Trump's order seeks to shield corporations from accountability and to centralize more power within the administration. It's not good to have one place, one person, one entity running all of these independent agencies. They're independent for a reason, for checks and balances. So we're going to keep following this and see what happens. There is some pushback on this, so we're going to see what's going to happen. Again, leave your questions and comments leave your questions and things in the comment section. My name is Lisa Davis. I am the Trusted Banker, and I will talk to y'all later. Bye.